Let us see the next question. A limited company's books reveal the following information. Net income is given, shareholders equity is given, asset turnover ratio is given, net profit ratio is given. You are required to calculate ROE, return on equity, of the company based on DuPont model. That is a question. I request all of you to go through the question, please. Dear students, over here, the question says that compute the return on equity. Then as a student, you are very much comfortable with the return on equity calculation. However, there is a new word which they have provided, that's based on the DuPont model. What does that mean? How you are required to present the answer? All those things that we are going to discuss over here. I request all of you to pay attention over here. Do not write anything. The question is providing net income of 3,60,000. The question is providing shareholders equity of 4 lakhs. Then it has been given asset turnover ratio 2.50, net profit ratio is 12%. This is the basic information given to us. Do not write anything, let me explain you. Information about the net income and net profit ratio can be used to compute the sales. So we can say that's the working note number 1, calculation of sales. Everybody is requested to pay attention. Net profit ratio is net profit upon sales into 100. So as far as the sales is concerned, it is net profit, that is 3,60,000 divided by net profit ratio, that is 12 into 100. So 3,60,000 divided by 0.12, that comes to 30 lakhs. So over here, sales of the company is 30 lakhs. That is what we can understand. Then asset turnover ratio is given 2.5. So we have sales, yes. We have asset turnover ratio, yes. So we can compute the assets. Sir, but why do we calculate all these things? Just give me time of 2 minutes. I'll explain that to you. Working note number 2. Calculation of assets. Asset turnover ratio is equal to sales upon assets. So basically we understand that over here, assets is equal to sales upon asset turnover ratio. What is the sales value? Sales value is 30 lakhs. Divided by asset turnover ratio is 2.50. That is what provided to us in the example. So 30 lakhs divided by 2.5. So it comes to 12 lakhs. That is the way the assets can be calculated. Now we have been provided with the equity and one more calculation that I'm going to do. That will be slightly new for all of you to understand. Working note number 3, calculation of equity multiplier. Equity multiplier is found as assets upon equity. So why do we compute this? Just give me 2 minutes of time. I'll explain that to you once again. So it is 12 lakhs divided by 4 lakhs. That comes to 3. Now, coming back to the important point. Listen carefully. We are supposed to make the calculation of return on equity. See, whatever the understanding that say we have at this point of time, based on that, so the return on equity can be calculated by using a very simple formula. It is net profit upon equity into 100. What is the net profit of the company? Net profit of the company is 3,60,000 divided by equity. What is the amount of the equity? 4 lakhs. So the answer can be calculated as 3,60,000 divided by 4 lakhs into 100. And the answer is 90%. This is the return on equity that say we can compute very easily from the given information. That is, nothing is supposed to be done. However, since the question says that so you're required to apply the DuPont model, so we are required to present the answer in a different way, and it has a logic like this. Everybody is requested to pay attention. It is net profit ratio multiplying with asset turnover ratio multiplying with equity multiplier. What is net profit ratio? It is 12%. What is asset turnover ratio? Asset turnover ratio is 2.5. And what is equity multiplier? It is 3. So 0.12 into 2.5 into 3. That comes to 0.90. That is 90%. This is the way the return on equity can be calculated. Now listen carefully what I am going to speak. Understanding of this method of the presentation, which Mr. DuPont had shown in one of his report regarding the presentation of the financial statement. DuPont is like the name of a person who presented this kind of report for the return on equity. He said something like this. Let us say that this is the trading account. This is P&L account. And this is balance sheet. Let us say that there are 3 things like this. The first is the trading account. Second is P&L account. And the third is balance sheet. See, there is a term that they have introduced over here, equity multiplier, which is calculated as assets upon equity. What does it mean? It means that for every 1 rupee of the equity introduction, assets of the company increases by rupees 3. That is equity multiplier. That is the first thing that they have explained over here. Let's say for every 1 rupee of equity that you introduce in the business, it is having the effect that the total assets increases by rupees 3. That is the first thing. Then asset to turnover ratio is 2.5. What does it mean? For every 1 rupee of the asset of the business, sales is 2 rupee 50 paise. For every 1 rupee of the asset of the business, sales is 2 rupee 50 paise. Over here, the assets of the company increases by 3. So 3 into 2.5, sales of the company increases by 7 rupee 50 paise. So when you are introducing 1 rupee of equity, assets of the company increases by 3. And so for every 1 rupee of the increase in the asset, sales increases by 2.5. So 3 rupees of the increase in the asset will increase the sales by 7 rupee 50 paise. Lastly, net profit ratio is 12%. Now we can very well understand, if at all the sales increases by 7 rupee 50 paise, it will have an impact that 7.5 into 12%, that comes to 90 paise. So increase of 7 rupee 50 paise of the sales will result into increase in the profit by 90 paise. So ultimately what happens? Ultimately it happens like this, that say for every 1 rupee of the increase in the sales, so the profit of the company increases by 90 paise. This is what we understand. DuPont model has given an explanation like this. When you increase the equity by rupee 1, your assets increases by rupees 3. That is what we understand is the equity multiplier. That is the first thing. Second, increase in the asset by rupee 1 will have the impact of increase in the sales by 2.5. So when sales increases by 3, when assets increases by 3, sales will increase by 7 rupee 50 paise. Net profit ratio is 12%. So this 7 rupee 50 paise of the increase in the sales will generate profit of 90 paise. So for every 1 rupee of the increase in the equity results into increase in the profit by 90 paise. That is what we understand. So dear students, from examination point of view, you have to compute the sales, you have to compute the assets, you have to compute the equity multiplier, that is a new point, and then you are required to compute the return on equity the way I have done it with the red pen. Okay, that is what you are required to do in examination. I request you to write down answer. Return on assets. You may write this if you want, not mandatory. Let us see the next question. ABC company sells plumbing fixtures on the terms of 2 by 10 net 30. Sir, what do we understand with the term 2 by 10 net 30? It has a meaning like this. Listen carefully. Credit period is 30 days, comma, if customer pays within 10 days, comma, customer will get cash discount at the rate 2%. So 2% cash discount if you make payment within 10 days, otherwise you have to make payment within 30 days. Its financial statement over the last 3 years are as follows: 2020, 21 and 22. Cash is given, accounts receivable data is given, inventory that is stock is given, net fixed asset is given. On the liability side, creditors are given, accrual, short-term bank loan is given, long-term debt is given, common stock, it means equity share capital is given, retained earning is given, then sales is given, COGS and the net profit is given. This is what's the information provided to us. Analyze the company's financial condition and performance over the last 3 years. Are there any problems? That is a question. I request all of you to go through the question, please. Dear students, this is what's one of the question which I have provided to you along with the answer, in which say I want to tell you something like this. Very rarely we have such kind of questions wherein we have to decide that which are the ratios to be calculated. See, the information is provided to us. Let's say analyze the company's financial position and the performance over the last 3 years. So over here we are required to decide which ratios to be calculated, and those ratios are required to be calculated for the purpose of analysis. Here is the suggested answer of the institute which I want to show you, in which they have calculated certain ratios like this. They have computed the current ratio, then they have computed the asset test ratio. So these two ratios are forming part of the liquidity ratios. Then they have calculated the receivable turnover ratio, average collection period, inventory turnover ratio. These three are activity ratios, that is debtors turnover ratio, average collection period and inventory turnover ratio. Total debt to net worth, long-term debt to the total capitalization, these are capital structure ratios. GP ratio, NP ratio, these are profitability ratios. Total asset turnover ratio, that is again calculation is made for the activity ratio. Return on asset is the profitability ratio. These are the way the ratios are calculated. See friends, what I want to tell you over here, from the given information, it is definitely possible to calculate some other ratios also apart from the ratios that they have provided to us. Second thing, let's say there is no precise list for this kind of question, let's say which ratios are supposed to be calculated. We are required to calculate the ratios preferably from all the segment, like to measure the liquidity, to measure the profitability, to measure the capital structure of the company. If at all there is like the debt financing, then the ratios from the lender point of view, from the management of your point of view, activity ratios. These are certain ratios which are required to be calculated, and based on that we can pass comment. So from examination point of view, you don't worry, you don't have to precisely calculate these ratios only. You may make the computation of the ratios other than this also, and with that you can calculate the answer. As far as the analysis is concerned, analysis is also required to be given in a very general method. It is not precisely that you are required to write this answer only. Very much like general comments are expected from you to answer this question. So far, like I can say that over the last 10 years, the institute has never asked any question in which you have to decide which ratios are to be calculated. Always say they will provide you say the list of the ratios which are required to be calculated, or otherwise say there will be missing information question. But since this is an exceptional question, so I have just say covered that say for the purpose of discussion. I request all of you to go through the question, and that is say go through the answer. That is like the very general way by which say the answer is given.